So in January of this year, January 11th or 12th or something like that, a whole slew of ETFs came out. There were two that came out in like 2021, late 2021. BITO there is it's a Bitcoin strategy ETF. It's got about 2 billion in AUM in that fund, but this is a futures based contract. It's not spot. So there is some drag. We wrote about this. A while back. But when you roll those futures contracts, just like any sort of like oil ETF or the natural gas ETF, anything like that, there's a drag when you go from contract to contract.
So spot is exactly like going out and buying a stock. So if I were to go out and buy, McDonald's spot rate, so to speak, I may be making that terms up as, I don't know if that pertains to stocks, but let's pretend it does, even if it doesn't. For $296, I'm actually going and buying the shares. If I buy a future, I'm saying, that, in 3 months or whatever the time period is, if McDonald's price exceeds this amount, I'll make money on my futures contract. If it doesn't, I don't make money on the futures contract, and there's a cost to write it. So spot is actually owning the shares. Yes.
And GBTC was like completely different. GBTC has since converted into an ETF, into a spot ETF, which is great. So now they can buy and sell Bitcoin with a commensurate value of how much money they're taking in each and every day. So the interesting thing here is, because they were first to market and people have been holding their ETF for, I don't know, like 5, 6, 7 years at this point. I think it came out in like 2015, 16, something like that. You can see the AUM is so much larger than all the other ones. It has nearly 23 billion in AUM. And if you look at the flows, they've actually been losing a lot of AUM because their fee is so high. Now, you can see it's got a 1.5% fee. Everything else is under 1%. There's one spot ETF that's higher. I don't even know if it's on here. I don't even think we included it. There's one at like 0.9% or 0.75% or something like that. But most of the others are around 0.25, 0.2%. There's one at 0.19%, the Franklin Templeton Bitcoin ETF. But because people have been holding GBTC for so long and Bitcoin's gone up, they're sitting with an unrealized gain. So the question kind of becomes, okay, yeah, the fee's full percent higher than most other options out there, but are you going to realize a capital gain just to get a 1% less annual fee? I don't know.
Right. Are you going to realize a 23.8% capital gain just to save 1.5% a year?
I guess if you're going to hold Bitcoin for 20 plus years, maybe that makes sense.
Right. So GBTC is just making the bet that more people will stay in the fund, even though it's more expensive, and therefore they can charge more just because of that function.
What's 1.5% times $23 billion?
It's a big number.
They're making a lot of money. So yes, their AUM has gone down, but I don't think they really care. They're probably happy with what they're making.
Sure.
And their first mover advantage, maybe that allows them to trade with a closer spread or have a better deal with Coinbase and lower transaction costs when they get their Bitcoin. I don't know. I haven't read the fine print, but I think it's interesting. Point being, if you're going to buy one, I probably wouldn't buy that one just because it's got a higher fee now that they're all similar.
Right. Or if you're already bought in, I probably wouldn't buy more of it. I'd probably buy one of the others, while you leave, what you have in GBTC, if that's the choice you're going to make.
Yeah, you can do the math on the taxes and what the returns might be over time and what your break-even point would be. But like if you're holding it in an IRA, there's no tax consequences there. So it probably makes sense to switch to a cheaper one. But I think it's worth noting, pretty much everyone uses Coinbase as their prime broker, their trading platform when they're buying and selling the Bitcoin. So, hey, maybe that's a good thing for Coinbase stock, right? I think they just came out with earnings and it was surprise positive this last quarter. But I see a lot of people buying Coinbase stock as a way to not buy Bitcoin, but sort of the picks and shovels approach of like, all right, if everyone's going to use Coinbase to transact, maybe I'll just buy shares in that. And whether the price goes up or down doesn't really matter to me, but I'm going to make money transacting over time.
Which is interesting too, because as Bitcoin becomes more popular, technically Coinbase's margins should shrink. So Coinbase should theoretically get less profitable, from a margin standpoint, as Bitcoin grows bigger and bigger and bigger. So it's almost, the ETF is almost helping and hurting at the same time.
Which they have. It used to be like $100 just to place a Bitcoin trade.
Which is absolutely nuts.
But you saw the same thing with stock trading. That's the crazy, like people forget this, but stocks used to trade in the 90s in eighths of a dollar. Like eighths of a dollar, 12 and a half cents. So they didn't even have pennies. That was decimalization. So, and it used to cost like $25, $50 to place a trade. And trading's gone away and you have decimalization. So the spreads have gotten tighter. So, things have become more efficient on the stock side. Same thing with cryptocurrency. Actually, I don't like to call it cryptocurrency, but digital assets, same thing. It used to be like $100 just to trade minimum, or they would charge you 2% if your trade was big enough. Now it's come way, way down. And like you said, the margins are shrinking. So,
right. I mean, look at stock trades now. Most stock trades are $0. Right. What happens to Coinbase's business model when it gets to that point? I don't know. Maybe they.
If anyone's listening and you're still paying trading commissions, please call me after this. You shouldn't be. PSA. And so I think the point here is some of these, the AUM numbers are what I'm looking at. I don't.
Right.
A quarter of a percent versus 0.2%. ARK tried to get creative and did 0.21 for the 21 million Bitcoin. So that's, one decimal point. Look, you're splitting hairs over the fee, but take a look at the AUM. And if you're going to pick one of these things to invest in, you could bet on your horse now, or you could wait a couple months and see, who's going to be around for a while, because there are costs associated with maintaining these ETFs. And if they're not going to be picking up funds, then I don't know that, you run the risk they're just going to liquidate, give you your fair market value back and close up shop.
Right. So, and AUM, or assets under management, is important because that generally means there's more people transacting it. So when you go out and buy it, right, you're going to get closer to fair market value. Yep. Usually when there's less of an AUM, a lower AUM, especially when you're not around that $1 billion or more, you're going to be looking at a bigger and bigger haircut on, when you transact it versus what fair market value is at the time. And then it also could be tougher to get out of a fund, an ETF, when there's a sell-off or a major run on the Bitcoin or the fund itself, because there's going to be less people, right, transacting in those smaller funds. So you generally want to go for a bigger fund. Over $1 billion, you start splitting hairs, but you generally want to go to, a bigger fund, just so that, you don't have to take as big of a haircut on transactions. And then also, should there be a run on the position, it is more likely that you'll be able to get out of it closer to fair market value than having to take a deeper haircut.
That's a good point. I mean, look, they're all supposed to trade at fair market value. That's what market makers are. That's like part of the structure of markets. But the more AUM, probably the better if you have a choice. This was pretty historic landslide moment.
I mean, this was huge in that I don't think we've ever had 10 ETFs all come out at once. I don't think that's ever happened for the same asset class, right? I don't think it's ever happened. I don't even think
SEC
5
had to do it this way. If they had given approval to some and not others, it would have been such a nightmare for anyone else trying to come in. So they said, let's just release them all at once. Anyone who had applied got approved, basically. Some people, I think there was 1 or 2 people that backed out of it because they realized they weren't going to be able to win in a horse race against BlackRock and Fidelity from an asset perspective. So I think it's fair the way they did it, but it flooded the market with potential opportunities. So it's probably good for the consumer at the end of the day.